Welcome to TradeTheMBI.com. This is John. This report is for the 20th, and well, we expected a little bit of pullback, and that's kind of what we got. A little bit of softness as we reached that peak 2,700 number. That was the whole discussion that the likelihood would be to sell the news as we got back up there. And again, just like I said, that 98 was going to be a little bit of resistance, and they tried to push it, but to no avail. And then you had some technical hiccups with the thing, but at the end of the day, it still passed, and that's still going to be bullish going forward. So I think that it's in pretty good shape. You can see from DOC reading, short-term buyers faded out quickly on it, and we got the spike back up to the peak. So we could see some a little bit more fluctuation back in between them. We're still got a rising shakeout, so you're just about to see that encounter here. The fact that you've already got a reset of short-term buyers means that any pullbacks are going to be relatively modest. Turning to the NQ, same situation, exactly identical now, and so we're pretty much in alignment, at least with where price is, but we do see a very big difference in the overall readings from the shakeout. It's much lower on the NASDAQ, meaning it's not as overbought. We're just approaching the warning line at 15 right here, that yellow line, but still rising. The fact that short-term buyers and that have all crossed here, a little bit closer to a general DOC spread, but you can see the orange, not anywhere near that same overbought. Euro continuing its press, the whole Brit exit thing. It's just a strange thing to be seeing the euro rising under all of that strain. But this is not uncommon when we see the kind of, central bank manipulation situation, and this is right in line with that. I mean, we had the buy signal that developed on the little dip that came back down over here, and it's really pretty much replayed that move. But you can see a little bit more short activity is starting to rise back into it, meaning they're satisfied that with tax reform and things like that, they actually may let the euro fade just a little bit. So we'll have to see. That should be the expectation. This one is a pretty obvious one. We expected people to get woke on this idea that, hey, the yield is really going to start to have some interesting issues, because as interest rates rise, you're going to get an interesting separation between the dividend of the S&P versus what real interest rates are. That is going to change things for the market, I think, because the reality is people then say, well, I can get a much safer, decent return as rates rise that way, and then may be more inclined to spread towards the security of the treasuries, particularly if they're believing the market is overbought in extreme. So we expected this one to come way down and fast, because with tax reform, the growth that's already started should accelerate quite rapidly, and if that's the case, then the multiple that everyone's worried about now will seem cheap going forward. So that's something to keep in mind. Oil continues to hover right at the same location. This is just an indication at this level that not only we reached an equilibrium, but that we see a growing economy, and I would expect that this has the potential to continue to rise. We got, obviously, at this particular point, we're still in a weak DOC reading here, meaning that we don't have any impetus for something to break, but we're not also falling through the floor and crashing, even though that we've been seeing lower demand than expected, but some of that is an increase in supply, so that's going to get weighed. But the fact that we're seeing significant economic growth, there's no other way to translate it. It's going to result in higher consumption, and that's going to be a benefit, particularly if it stays at a low rate. It keeps inflation under control, which then begs the question, do rates really need to rise? And that becomes the interesting debate, particularly with the change that's going to take place at the Fed. Will we get this lagging, which is what, from my macro view of things, is the smartest policy, is to trail inflation significantly, because that reduces the debt burden and puts it onto devaluation of the currency. Not that everybody agrees that that's a great thing. It still makes a difference. Now, when we look at gold, it's still continuing that little press. We haven't seen the beginning of the fade off, and when we do, it should make a return back, at least depending on where this final is. We haven't seen the short break out of it just yet, but it will come back and fill that back in. And again, this gets back into, if we put up our little Bitcoin, the transference of, decline in Bitcoin usually going to correspond probably to small increases, or I haven't seen the relationship yet as to the inverse for gold and Bitcoin, but we ended up with this beautiful short signal here, and as I said, we came down to the bottom. We expected a return back up to the 50%, and that got rejected nicely with the nice little short signal right about there, which dropped right back to the 23%, and we made significant declining lows right through there, so that was a pretty nice read. No objection with it whatsoever. And so when we turned to our 5K, we had the nice run up, and as I said, the likelihood was that you would sell the news, they would try and pop it to the highs. They got there, they were unable to really break into a new uptick, and that failure to break into a new uptick meant that, as you started to see declines from, DOC, cyan, rising along with the steel fading, and as well as the midterm and long-term buyers here in the green and red just continuing to cascade lower, led to new lows, and then it just kept cascading here because we go really deep in our shakeout. We finally stabilized, and so on this most lower low with the higher shakeout reading, we had actually some stability. It still hasn't produced any significance until we ended up with right before this breakout right here that took us right back to 50% and back up. So still right in line with where we expected to hover around before we break that 27, but still the likelihood is that we move over that 27 before anything else happens, and it's a nice start to the pre-market. Just backfilled a little bit, took out some of these positive extremes from the previous day, going all the way back over to here. I think we had some that were all the way down in this area back here, and so all that's been filled in and taken away. So, healthy action. That's the only way to describe it, I think. It's tough for people to understand, but you've got this trade that's related to end-of-year performance and that, and so anyone who's been behind the curve on the returns by being bearish is going to have to make up for those, and it's going to actually fuel more buying, and this is something that's more performance situation. So we could see some volatility at the very end of the year to the downside. So it's something to pay attention to, because at that point they will have booked their year and taken whatever gains. And so there's going to be a little bit of gamesmanship here, I think, towards the last 10 days of the month. So that's something to be aware of, which is just going to add to volatility. So be prepared, and I wouldn't be afraid to short signals to the downside, because I think that you probably see some decent moves both directions. So that's the long and the short of it. As always, though, trade well. We'll talk to you later.